Hi guys, it's another session with the Tattoo Business Doc. I'm Dr. Justin Buerta, and you can always follow us on our website www.tattoobusinessdoc.co.za. Again, it's www.tattoobusinessdoc.co.za. Now, I've got this little guy sitting here, it's a boy reading a book, and I've got the big thinker here. I always like using a bit of a prop. And my producers just advised me that when I speak about the current generation or the younger generation, it's the Generation Z. So, well, I can make a lot of jokes about that because they probably have the level of intelligence of a toothbrush. And they are so full of themselves they can barely dress. And hell, they live through a cell phone or some sort of media or some sort of thing. And that's why the world's now turning around and stopping them from being able to go on to social media until they old enough to know what the hell it's about. And this also goes directly into reporting. So this session is all about the new reporting standards and how reporting is going forward. And I want people to understand, because I've got a degree in integrated reporting, and I've always got to explain to people what that is about, because we've got a lot of different aspects that we've got to deal with. You've got to deal with your corporate governance and everything that's got to do with that. And they talk about the capitals and all those kind of things. Your staff, your debtors, creditors, all of them are capital. Your shareholders also become stakeholders, all these kind of things. So it's all about stakeholders, basically. Everybody that's got to do with your business, they need to know what's going on in your business. Which nobody will tell them when you're a small business. You won't do it. But if you go and read on Woolworths, Pick n Pay, and all the big listed companies, you go onto their websites, you'll find what is called an integrated report. Okay, it's an integrated financial report. So what that is that you've got your financial reporting, which is your old set of financial statements, your statement of comprehensive income, financial position, cash flows, and owner's equity, and then all your notes explaining where the figures come from. Now, the other part of that report is your non-financial reporting. This is your sustainability reporting. So what is your footprint in the world? Okay, are you a green company, not a green company? Do you support things? Don't you support things? What are you doing to help society? What do you do for your staff and all these kind of things? It is those non-financial information indicators which people want to look at before they decide to invest in your business and to invest in you. So now you've got this big 45 page booklet that you can download. And trust me, like they said to me when we were doing the degree, that it's a very pretty little fairy tale book. Because it is. It's a fairy tale book. Nobody will tell the world that they're burning half of the world's resources to produce what you want. We're sitting in a scenario we're sitting in right now because we're 20, 30 years beyond the point of lunacy or practicality in terms of turning the dire situation of the world around. I mean, we're overpopulated. We're also overpopulated a lot of things. But even if you've got situations like the Iran war, Russia, Ukraine, everything else, that now needs to be reported in your financial statements, because that has the potential to significantly impact your company's financial situation as well as the situation of your company in the global environment. So these days you'll see there'll be a lot of more sustainability reporting coming through, because the UK is now adopting the same sort of system, and once the UK starts doing it, Europe will do it as well. Europe has got it on Sarbanes-Oxley and all those kind of other things. Americans, well, they don't like telling anybody what's going on there. So their reporting standards are still based on the US GAAP systems. They don't follow IFRS, or not that much, because Americans like doing it their own way, and they do corporate governance a different way. But it also impacts your BEE, and it's something that I just need to touch on here, guys. You got to understand that your expenditure for BEE is generally allowed as a deduction for tax purposes. And it also obviously impacts your profitability and everything else. But if you don't do the expenditure, you don't do the skills development, you do not do the socioeconomic development, you do not do the supplier development, and all those kind of things, and your preferential procurement, and all those kind of things, if you don't do it, your BE scorecard's going to look terrible. Terrible. And a lot of people always say, but we don't have the money to do it. And that's the reality, you don't have the money to do it. But in general terms, you will be allowed to use that as tax deductible expenditure. Because, I always say substance over legal form. When a person looks at a transaction, you need to see what for what purpose that you do this. You're doing this, but the purpose be so that you can keep your doors open, so you can get a level, so that you can have the best practical position to be in to do more business. And it's becoming a big thing. I mean, people are spending a hell of a lot of money they just simply don't have. But then again, if you're doing skills development, make sure you're doing it through the right places so that you can claim against your STI levies that you're paying. Get your rebates back. Claim your, it's not going to be all of it, but you're going to get some of the money back. Yes, okay, you're getting the money back, so, it's another income stream, and yada. But at least you had the expenditure, and it's all about the expenditure. It's not necessarily how much you get claimed back. And I know this because it's now time for the workplace skills development plans. It needs to be in quite soon, and then we've got employment equity, which is coming later. So there's so many things, and this all impacts accounting because it impacts taxation, it impacts HR, it actually impacts absolutely everything. And we will have a session where I will explain to you in more detail how I look at things, because there's laws. A lot of people will say there's, I think, about 42, 47 laws, which is racial-based laws, and there's also laws which is really starting to impact how business is done. So we'll run through all those. But the greatest thing is that you've got to understand that your reporting will start getting a lot more cumbersome. There'll be a lot more to be reported on than simply the profit and losses, assets versus liability, profitability, solvency, liquidity. You're going to have to report a hell of a lot more. It's mostly now for listed and being big corporations, but it's going to filter through to the rest. It's already happening with beneficial ownership declarations, FICA declarations, everything else, and customs and excise, SARS, all these kind of things. So your reporting is going to get quite cumbersome going forward, and obviously the world's catching up to this. South Africa was quite a trailblazer with integrated reporting. We did the first degree in that, and now the rest of the world's catching on and learning from us. So guys, do understand that accounting is going to get a lot harder, and that's where professional judgment will be a lot more important. So again, I would urge you to ensure that whatever you do in terms of finances and accounting, everything else, that you really understand your financials, understand where your business is. Everything else is only, you can't turn around and say, well, my accountant knows Symphonium. You should also know, guys, your financial reporting is going to be a key factor in business going forward. So do understand how financials work, do understand how those things work, and understand where we're moving towards an integrated reporting framework. As always, guys, I got your back, and I'll see you in the next session. Everything will be okay.